Hi, I'm Nicole Berman. Stock-based compensation is exactly what the name implies. It's compensation that's paid in stock, or it could be paid in cash, based on the value of the stock of the company. And like a regular paycheck, these costs need to be recognized over the service period the employee's services are rendered. I find it helpful to think about this model in 3 steps. First, figure out when the award's granted, which is typically when the award's value is measured and when the accounting starts. Second, determine whether an award is equity or liability classified, which is often driven by how the award is settled. This point affects both the classification as well as the fundamental accounting treatment. And third, determine the pattern of recognition. The first step is the grant date, which is when the requisite service period usually starts. There are several criteria that need to be met to have a grant date. First, the employer and the employee need to have reached a mutual understanding of the award's key terms and conditions. This would include the exercise price, the option term, and any performance conditions or targets that need to be achieved to earn the award. Second, the award must be formally approved by all required parties. For example, if the board is required to approve the award, but it has not yet done so, even if management expects the award to be approved, you typically won't have a grant date until the board approval is received. Third, the company must be contingently obligated to issue the shares, meaning that if the employee provides the required service and any other conditions in the award are met, such as performance targets, the company is required to deliver the shares. They don't have any discretion. And lastly, the employee needs to be exposed to movements in the value of the market price of the company's stock. In a typical stock option award, this is straightforward. If an option is granted with an exercise price equal to the market price at the grant date, the value to the employee depends on whether the stock price goes up or down. The second key step is to determine if the award is equity or liability classified. Generally speaking, equity awards are settled in shares, whereas liability awards can be settled in cash. However, this is not a straightforward determination, and the characteristics of the award need to be carefully evaluated to determine the appropriate classification. This is critical because classification doesn't just impact the balance sheet presentation. It fundamentally impacts how the awards are accounted for in the income statement as well. The most significant difference is that the total expense for equity awards is fixed at the grant date fair value, whereas the expense for liability awards is remeasured each quarter at the current fair value until settlement. Now that we've established the grant date and determined if the classification is equity or liability, we look at recognition and measurement. I also want to mention 3 types of conditions that impact recognition and measurement that may be present: service, performance, and market conditions. Service conditions are the most common. This is when the award vests if an employee provides an agreed-upon period of service. For example, a stock option may vest after 4 years of service. Expense would be recognized over the service period for those awards expected to vest. If the service is not provided, the expense would be reversed. Performance conditions are when an award vests if the company or an employee reach a specified performance target. This could be an award that vests if a specified sales target is achieved or upon completing an IPO or in the event of a change of control. Expense begins to be recognized when it's probable that the service will be provided. This target will be met and the award will ultimately vest. If at the beginning of the period the performance target is viewed as probable, the full amount would be recognized over the vesting period. However, if at the grant date it wasn't probable, but halfway through the year performance improves, no expense would be recognized in the first half of the year, but then expense will be caught up and recognized when the award becomes probable. Similar to service conditions, if the performance target is not met, the expense would be reversed. Market conditions are linked to the value of the company's stock. For example, if an award may vest if a company's stock price reaches $50, or if total shareholder return exceeds the company's peer group index by 10%. Here, the recognition of expense incorporates the estimated probability that the market condition is going to be achieved, and it's recognized even if the target's not met and the employee doesn't end up earning the award. For more information on this topic, please refer to our Guide to Accounting for Stock-Based Compensation, available on CFOdirect.com.